just a little advertisement before we get started here. My newsletter is Jay Taylor's Gold, Energy, and Tech Stocks, and you can get a little discount if you want to try it. I think a 3-month discount if these little blue forms that you get when you outside the door. Just put your name and hand it to the folks out at the desk, and you can get, I think, $45 for 3 months, something like that, just to give it a try. So it's miningstocks.com is the website for my newsletter, and I also host a radio show called Turning Hard Times into Good Times that's aired every week at 3 o'clock Eastern Time, 3 to 4. A lot of the people that are here at the show, some of them have been guests in the past, and we have a lot of very interesting guests on the show, so I hope you'll, if you haven't tried it, we'll give it a try. It's a live-based web show. Okay, I've titled my talk, Is the T-Bond a Judas Goat? And a little bit of a background of that. I understand that goats can be trained to befriend sheep and then lead them to the slaughter. So they also can be trained, I guess, to lead cattle around to different places as well. So my question is the T-Bond a Judas goat? The idea behind that is that we're hearing all the time that interest rates are rising because the economy is getting strong, because it's getting better, because the Federal Reserve in its infinite wisdom knows what it's doing. And I would suggest there are some other more sinister reasons why interest rates are rising. Whilst the Fed wants you to believe that it has everything under control and that things are getting better, I think there's not a lot of evidence for that. In fact, I'll try to show you that I believe it's the opposite, actually. So this is the GDP that the government will give you. This is what we get from the government. John Williams, who's an economist who looks very carefully at inflation accounting and has his own inflation measurements, says that our GDP is more like this. This is his. And essentially, the inflation numbers are higher or much lower than they really are in reality, according to John's work. If we went back to before Reagan, the way the government accounted for inflation, they would take the same basket of goods one year after another, and it would be consistent. More recently, they started using substitution. So, for example, if steak gets too expensive, they use hamburger in the index. The other thing was hedonic pricing. So you have the fancy cars with all the extra things on it that we never used to have. So if your car costs you $50,000, they discount that by some number because you have all these extra gadgets. Doesn't mean that you go from point A to point B less expensively, but you're led to believe by the CPI that you do. So John takes that kind of accounting into effect, and his view is that we have never really had any significant growth since 2008, 2009. Now, I think there's a lot of evidence to back up John's thesis or his work. The percentage of able-bodied Americans with jobs has never really fully recovered. We've had a little bit of an uptick, but this chart shows the American workforce isn't what it used to be by any stretch of the imagination. 40-hour work weeks. Okay, so we've had people making $60,000 or more. You know, that has gone back to about where it was before the crisis. However, the number of wealth-creating jobs, you know, we're more service jobs, less mining, less manufacturing, all that sort of thing, has never really recovered or reached the levels that it was before the 2008, 2009 crisis. The number of people, now this I think is really telling, 26.5 hours per week, making $20,000 a year. There you can see what the number of people, they've grown very, very dramatically. So people have jobs, but they're jobs that aren't paying nearly as much as they used to pay. This is corporate profits before taxes, rolling over now. You wouldn't think that's a sign of the economy getting stronger as interest rates are rising. There's a significant decline in employment growth in S&P 500 companies. In fact, it's declining. Well, maybe part of that has a lot to do with technology. I wouldn't doubt it. But nonetheless, you know, those really good jobs white-collar jobs are disappearing to a great extent as well. This, I think, is as telling as anything. If the economy was doing so well, why is the Treasury, you know, why are Treasury receipts in decline right now? receipts are in decline. Maybe more people are cheating on their taxes. I don't know. I don't think so, but I think the government has a better way of tracking us than ever before to make sure that doesn't happen. So I'm skeptical that that's the answer. I think it's more that the economy just isn't as robust as the Federal Reserve would have us believe. J.P. Morgan is reducing its GDP growth view significantly down to 0.3%, which is very much in line with the Atlanta Fed's view, which is, Eric Coffin likes to talk about this a lot. The Atlantic Fed has been spot on in its forecasts, better than the other Feds, and it's suggesting a 0.2 GDP growth number. So maybe there's some other reasons why why rates are rising. You know, it could just be that people aren't really all that excited about buying treasuries that pay less than what the inflation rate is, even the government's inflation rate. It could be that there's a disappearance of willing buyers of treasuries. This shows that foreigners, this is a chart showing the decline in foreign purchases of treasuries. Another major source of treasury financing has been the Social Security Trust Fund. Now we have a problem because people, I'm a baby boomer, I'm one of the older ones, and we're starting to draw down Social Security. At the same time, the job situation isn't what they like to make believe it is. So there's a lot less money going into the Treasury. So here you see the amount of reserves that the Social Security Trust Fund has to buy. Basically, they buy treasuries with it and then make believe that the government doesn't have such a big deficit. It doesn't, the U.S. government doesn't set aside the money for us. It buys treasuries with it. And it's in sharp decline, as you can see there, since about 2006. Treasury buyers, for the longest time, from the founding of the nation until recently, the biggest percentage we've had, foreigners have been buying treasuries. I can remember, you know, after Nixon took us off the gold standard and the U.S. started having these huge budget deficits, we said, well, don't worry, there's the kindness of strangers, foreigners will buy our treasuries, and they have. Up until 2014 or so there, you can see 43%. The 23% was, that was QE from 2008 to 2014, so the government went in and bought treasuries. You had a little bit of what intergovernmental, which was a Social Security Trust Fund. They were buyers of treasuries. So now what's happened since the last couple of years, since the Fed went off since the Fed supposedly stopped QE, all of a sudden, at least over these 2 years, you have this dramatic increase in domestic purchases of treasuries. You have 25% from intergovernmental, or intergovernmental is really mostly the Social Security Trust Fund. And you have a 12% decline of foreign buying of U.S. treasuries, the first time this has ever happened in our history, where foreigners are really backing out of buying treasuries. Consumer prices are rising. Interest rates should rise with consumer prices, so if I'm a lender, I want to have more of a return if the inflation rate is going up. That would be one reason some people may be less willing to buy treasuries, because the inflation rate is ticking up. You see GDP is almost zero, but prices are going up. So the real question is, how have rates managed to stay as low as they have when Treasury rates are so unattractive and when foreign funding is gone, or it actually seems at least over the last 2 years has gone. Social Security is in sharp decline, that source of funding. The Fed has stopped QE, or so they tell us, or I raise the question, or have they? Has the Fed really stopped QE? What isn't explained in that chart I showed you a minute ago with the domestic buyers is the Fed isn't, or the Treasury isn't telling us who the domestic buyers are. We have some of that information. Mutual funds bought $497 billion worth of treasuries in the last 2 years. You see banks have bought some, private investors a little, insurance companies bought a little bit. But there's something they call other, which is $745 billion. The largest chunk, the Treasury just doesn't tell us who that other is. Who is other? We don't know. But I put the question to my friend John Rubino on my radio show, and John says, well, I think it's probably some central bank somewhere that is pumping money into the system to suppress the Treasury, the interest rates. You see, it's impossible to hold this system together if rates start to rise dramatically because of the enormous amount of debt that's been piled up in the United States and around the world. So the rates have to be suppressed. They have to stay low, or else we'll have a depression that makes 2008, 2009 look like a walk in the park. It's really very, very serious. Right now, even with suppressed interest rates, you see what the amount of government net interest outlays are. Imagine if you went back to something normal, like 5, 6, 7%. It would just blow the budget out of the water. There would be no way that the Western world the financial system could survive. Revenues are completely consumed by major entitlements and interest. I mean, it will be by 2025. It doesn't even talk about military. And the military, the U.S. spends more for its military than I think all the other countries combined, or something like that. We're very worried about Russia and China. There's the issue is that debt is growing so much more rapidly than income is growing around the world, in the Western world at least. It's an insolvency situation that we have on our hands. This is a slide from my friend John Rubino showing that something like 1.2 trillion in emerging market debt has to be rolled over this year. John draws three inescapable conclusions: that interest rates can never rise, because if they do, it's going to blow up the system globally. The only solution then is a massive amount of currency devaluation or money printing to try to make this debt situation manageable. In other words, interest rates have to remain suppressed, and massive amounts of money have to be created out of thin air and pumped into the system. John also points out that this debt thing has grown almost parabolically. And so he believes that we're very close to some sort of resolution that isn't going to be a happy story. One of the things that I've come across recently, one of the ideas, Alistair MacLeod, who writes for Gold Money, maybe some of you are aware of Alistair's work, was talking about a major general in the People's Liberation Army who's come up with this theory about how the American empire works. Essentially, without going into much detail because we don't have time, the U.S., since 1971, expands the money supply. It pumps money around the world. It creates debt. Of course, that's how money is created. It's out of debt. It's not gold. It's debt. It reaches a level, and the Treasury now has a problem in funding itself, so it needs to precipitate some sort of a major crisis, whether it's a financial or military crisis. Then the money comes back to the U.S. in the form of the safe haven, which we always hear talked about. When the stock market goes down, money goes into treasuries, and it's a safe haven. So this is the idea that the U.S. Now, what the motives are. Alistair believes that the major general from China, he doesn't agree with his motives. Alistair believes that it's more just something that happens because people are serving their own self-interest. It's not as if a few people get in a room and decide they're going to precipitate a crisis. But nonetheless, this is sort of historical. You had the Latin American crisis, the Asian crisis, and now the Chinese believe what's happening in that part of the world is being precipitated in order to keep money flowing back into the Treasury, the U.S. Treasury. Because after all, it is only a promise to pay. It's not based on any asset value. Our currencies are all basically promises to pay by a government that is essentially broke. So what can we anticipate from policies? Increased taxes? I would say that's not going to happen. Taxes through inflation? Yes, that's likely, but outside, just outright taxes, probably not. There's a lack of funding, I'd say, from, as I just pointed out, from traditional sources of Treasury, so I think that means they're going to have to print money. Rates can't be allowed to rise, so I think what that means is we're going to continue to see negative or at least very low interest rates as far as the eye can see. Now, we get to gold. That is very bullish for gold. This chart documents that historically. The light blue areas are when interest rates are negative, real rates of interest, and that's using the government's inflation numbers, not John Williams. And you can see the results. Gold goes up when we go negative, or the direction of things. Interestingly enough, a regression model that's the 250-day lag showed until 2013 a direct correlation between the price of gold and the U.S. budget deficit. That broke down in 2013. I wonder why that did. I wonder why that happened. I don't really know for sure, but I do know that the Fed continues to give us its forecast, and they're continually wrong. People still believe it, though. Wall Street's still drinking the Kool-Aid, so Janet Yellen comes out and says interest rates are going to rise. They believe that it's because the economy is getting stronger. They believe the data that the Fed is giving them. So if the economy is getting stronger, then there's no need to buy gold. I mean, everything is hunky-dory. We do know that gold shares go up very dramatically in bull markets, and then they lose 80% of their value. We average about 500-fold on the index for gold shares. Then they lose almost overnight, within a very short period of time, 80% of their value. So how do we know when we need to get out of gold shares? Well, we need to know the real interest rates. Are the real interest rates going to rise or fall? And that hinges very much on the global GDP. So if global GDP is rising, that's bad for gold. If it's declining, good for gold. It should mean more stimulus, more money being pumped into the system. I just show you quickly this chart from Michael Oliver, a technical analyst that I have on my radio show almost every week because he's been so good. He's not at all concerned about the gold price right now, the last few days or so. He believes that we entered a bear market back in 2013, that his work was suggesting exit, and he's very firmly bullish right now in 2016 in February. And it's called the momentum structural analysis. It's very, very good, and would encourage you to consider thinking about his work and listening to my show, because I have him on every week. This is just a little, showing us a little bit the price of, this is cash flow to the senior producers, gold producers. It shows where it's at now. Historically, they're very cheap. Long-term gold equity to the gold bullion ratio, also very low at historically low levels. So that pretty much ends what I had to say about my talk, but some of the companies that are here, and a couple of them will be talking in a minute, that I invited: Klondike Gold, you can read the names, McDonald Gold, Sage Gold, Telson Resources, Tri-Metals Mining, and some of the others there that I follow that are covered in my newsletter are mentioned there as well. Klondike, we're going to hear, I'm not going to spend much time on this because I want to give the time to these gentlemen who can tell their story better than I can, but Klondike Gold is a very exciting story in the Klondike. It's the old placer mining region, the famous Klondike, and the company believes that they've figured out the source of this gold. There was a theory some time ago that it had all been eroded away. Well, Peter Talman will explain why that's not the case in a few minutes when he comes up here. I think it's a very exciting story with a market cap of 16 million Canadian dollars. Tri-Metals Mining is another company that I brought here that I like a lot. It's a lower grade, but they're finding higher grade, multi-million ounce open pit heap leach target in between Nevada and Utah. And I believe they're talking tomorrow. I believe they're storage tomorrow. Sage Gold Inc. is a real new entry to my newsletter. It's got a tiny market cap. We'll be hearing from them in just a moment. It's a very, very interesting story in the old Timmins camp, and one you're going to want to pay attention to. Telson, probably the closest to production of the companies that I cover, and they just announced the acquisition of another project in Mexico, a polymetallic project, so they have two. And the one that they just picked up for $20 million was sold previously for $200 million. It still, I believe, has a very significant mine life and a lot of profitable future. McDonald Mines, very interesting in the Wawa Gold Camp in Ontario. Some very unusual forms of mineralization. They'll be talking tomorrow about that, but also some lode and shear zones that are more traditional. But what I like about this story is the possibility of early cash flow from a sands target there, sulfide sands, oxidized sands target that's very interesting, and they'll tell you about it tomorrow. So the early cash flow could help finance the rest of it. So I'll leave you with this thought. We've had this massive amount of debt money pumped into the system, the greatest malinvestment of the history of mankind, because everybody went off the gold standard in 1971 when Nixon mandated that. And so what I think we have is the greatest crack-up boom and malinvestment in history. There's going to be hell to be paid, I'm afraid. And I'm a gold bug. I'm not a gold bug because I'm cheering for that day. I'm a gold bug because I believe gold is going to be one of the few assets, certainly one of the few portable assets, that will retain value when the crack-up boom comes to an end. And it isn't going to be pretty, I'm afraid. Now, maybe I'm just a crazy gold bug. You'll have to figure that out. I don't know. That's what I believe. I'm just telling you. My radio show can be heard the following day at J. Taylor Media as a podcast. It is a live show between 3 and 4 o'clock at the Voice America Business Channel. And you can either listen to it live or follow up the following day on a podcast. So that's the end of my talk, and I've gone over a minute already, so I better shut my pie hole, as they say. All right.